Markets bracing for the Fed's decision on interest rates, pricing in a pause in the rate hike path as inflation continues to moderate. Let's take a look at the U.S. equity futures at this hour. You'll see the Dow down by about 33 points below fair value. S&P and the Nasdaq both indicated higher, though. S&P up by about 10.5, the Nasdaq up by just over 36. Joining us right now is Liz Young, SoFi's head of investment strategy, and Megan Graper, who is Barclays global co-head of debt capital markets. Liz, let's just start with you on what you're expecting, how that's going to play out in the equities market. You think that the Fed may actually be done at this point?
I think there's a decent possibility that they're done. And I think the messaging that we're going to hear today is that at this point, the data shows them that they've already gotten to a sufficiently restrictive level. So they have the justification to pause. They certainly have it because of what happened with CPI yesterday. We know that Jerome Powell does not like to surprise the market, so I don't expect him to surprise us too much today. But he also really values flexibility, so they will likely leave the door open to moving further as the year goes on. But I continue to think about the fact that from the jump, he has reiterated over and over again that they do not want to make the same mistakes that happened in the 1970s with a stop-and-start monetary policy regime. So it's possible that if they pause today, they may not keep going. They're going to wait for the data to roll in and watch as what they call the long and variable legs of policy bake through the rest of the system.
You know, the one thing that was interesting, we were just talking with Steve Leisman earlier, and he was pointing out that at this point, the statements that you're getting from Powell are more dovish than lots of his members on the FOMC, that could be the biggest headwind that he's running up against. We were just positing maybe it's because he comes from a markets background, not an economics background, and he's worried about things that could potentially break. That's a good reason to pause and look around to make sure you don't break things as you continue to move rates up, especially if you think you're starting to get a handle on inflation. What do you think, Liz?
I think probably the era of unanimous votes on the FOMC could be over, and we will start to see some dissents, and we'll start to see a bigger spread between some of the dots on the dot plot, and we'll get obviously that data today. His background, I'm sure, forces him to look at what signals the market is sending. And we're still in this sort of situation where we've got an equity market sending pretty positive signals. And we did see strength broadening out. And that's something that we should all take heed to. But we still have a bond market that's sending cautious signals. Yeah. So I think he's probably paying close attention to that, knowing that if you have a credit market that starts to show a lot of signs of stress, it's really difficult to reverse quickly. So I'm sure he's taking that into account. The economic data, however, is still decently strong, or at least stable. Of course, we're seeing weakness, but not necessarily seeing anything that is terribly problematic at this point. So I think he's watching financial conditions. I think he wants capital markets to continue to function the way that they should. And that is something that they're going to take into account as he goes through this meeting and particularly the July meeting.
Megan, if you're trying to read signals, most people would say they'd rather take signals from the bond market, not the equity market. It tends to be right over time. What are those signals, the cautious signals that they're sending out? What do you think about it all?
Yeah, I mean, I'd take a slightly different side of the coin there. I think, markets are clearly convinced that the Fed is going to hold today, but I think the data actually justifies a risk to a hawkish surprise here. And, so I think while I agree it would be incredibly uncharacteristic of Powell and this Fed, frankly, to catch the market off guard, if there was ever a time looking at risk assets to go against the grain and to lean in or against some of the pre-blackout cues we were hearing from Jefferson and others, I think this may be it. And it's because you've got the VIX back to 14. I mean, those are levels we haven't seen since early 2020. Risk assets across the board are basically rallying. That's looking at credits, looking at equity markets. And sentiment is rarely, if ever, this benign. So in that context, I think today has become less about the skip and more about what they ultimately communicate about the path forward. And our strategists are calling for another 50 basis point rise in the medium dot for the terminal rate, alongside of an upward revision to inflation. So the combination is clearly far more than the market currently has priced in, but I think the backdrop would be supportive of it.
Even with the inline CPI data that we got yesterday?
I think that's right. I mean, you can look at the strength of the labor market. I think you can look at wage data. The Atlanta Fed wage data, I think, is something that has got to be causing some degree of worry. We've seen housing prices rebound. And I don't think that inflation is sufficiently moving lower faster enough with its 2% target in mind. So I think it was in line with expectations on CPI, certainly not enough to compel them to move at this meeting. But I think both July and September potentially are back on the table.